One of the concepts I tell clients is that you will exit your business in one of six ways and only one of six ways. You will sell it to family, you will sell it to management, you will sell it to a third party, you become an absentee owner, it gets liquidated, or you die. And if you do not choose one of the first four, the last two will happen. However, the best way always to sell a business is preparing as if you're an absentee owner. Because the one difference when you sell a business is you're not there. And if you haven't transferred that intellectual property that's up here, that has made this business successful, you're not going to maximize the value.
Welcome, Kicking Ass and Taking Name, the Business Owners Empowerment Podcast. I'm your host, Marlon Griffith, Esquire. Join us on this podcast journey as we help you break free from the grind and get your business to work for you. We will delve into impactful conversations with business owners, corporate leaders, professional service providers, and industry innovators that will provide you with insights and actionable strategies that will transform your entrepreneurial path, boost your success, and put you in control of your business journey so you can kick ass and take names.
All right, folks, I have my good friend Stuart Sorkin. Stuart often says you will exit your business one way or the other. So why not exit your business on your own terms? Now, Stuart is the author that I have in front of me, and I've read the book. It's the co-author of Expensive Mistakes When Buying and Selling Companies. Welcome, Stuart.
Thank you. Thank you. Glad to be here.
Now,
look forward to our conversation today.
Absolutely. Now, you have a few initials after your last name.
Yeah.
Let's talk about those.
Okay. I have a JD. I have a law degree from the University of Miami. I have my CPA that I got at American University here in DC. And then I have a master's in tax from Georgetown. But probably the two things that probably make me unique in what I do is that back in 1983, I started the tax application software division for a little company called Coopers & Lybrand. And I built a department of 14 people in 4 years. So I'm an actual attorney who's actually built a business in technology. So it gives me a broader base. The second factor is that my father was an entrepreneur and a businessman, and he was nice enough to let me sit in on a lot of meetings, and I learned about the art of the deal at his knee for a long time. So I got a very background, and then obviously writing the book got us to expose a little deeper. But you sort of hit one of the concepts I tell clients is that you will exit your business in one of six ways and only one of six ways. You will sell it to family, you will sell it to management, you will sell it to a third party, you become an absentee owner, it gets liquidated, or you die. And if you do not choose one of the first four, the last two will happen. However, the best way always to sell a business is preparing as if you're an absentee owner. Because the one difference when you sell a business is you're not there. And if you haven't transferred that intellectual property that's up here, that has made this business successful, you're not going to maximize the value. And we'll talk about a couple of specifics. But I also want to say that running a business is very different than setting up for transition. Most, I would say 95 to 99% of the entrepreneurs that I know that are successful are partially successful because of their belief in themselves.
Absolutely.
However, when you are starting a transition plan, you now are no longer the smartest man in the room, and you have to learn to delegate. Because if you don't delegate, you're not going to get that information out of your head. So you have to fight the battle of, I want to do this because I know I'm going to do it the best, versus that's going to hurt you in the long run in trying to maximize the value.
Now, you have a ton of experience and knowledge, but before we start getting into that brain of yours, tell me all this. What exactly do you do, Stuart?
Okay. I work with with entrepreneurs across the country on helping them develop succession planning. Basically, the concepts here are, though, that in succession planning can either, as it's generally going to be either internal, family management, or third party. I tend to concentrate on the internal market, one, because it's underserved, because people, you've got brokers, IBs, all these people who are willing to help those people if they're ready to sell. However, most of those people also are in a hurry to sell you. So they may see issues that would add value, but they're not willing to necessarily have you correct them because they want to get moved to the next deal. So the concepts of you need, if you're going to work with a broker is to say, okay, what are my weaknesses? Are there things that I can do? And maybe if we push this off 6 months, can improve my value by 5 or 10%.
When I read your book, the one thing that jumped out at me is that your co-author, you basically state running a business to make it sellable is different than running a business just to serve you.
Correct.
Expand on that. What do you mean? What do you mean by that?
Well,
and what does that look like?
Okay. If you have no operating procedures, you have no employees, what do you have to sell? The idea here is that if you want to have something to sell, you've got to create it. You've got to create the SOPs. You've got to potentially train employees. You've got to figure out, because a successful business to me is somewhat like a three-legged stool. There's accounting and finance, there's product delivery, and there's marketing. All entrepreneurs start by doing all three. The smart ones figure out what they don't like or what they're not good at, and that's when they bring in a key employee or partner that takes over that so they can grow and leverage. Because a lot of businesses fail because the owner is doing a lot of things that he's not good at, that they're taking up his time, and therefore he's not focusing on the things that he is good at that will really add value to the business.
So, like, say it maybe a little different way is when someone is looking to buy your company, they're not looking to buy you.
Correct.
Or what your company's created, or what your company creates, and how they create it. So,
Correct.
everything is done by you, well, then you're not you're not
Correct.
sellable. So,
And the other side of the coin is most acquirers do not want the seller to hang around for an extended period of time because it has bad effects on management, because they'll go to the old owner if they're not getting the answers they want, creates friction. The other side of the coin is that the true example, my co-author Dick walked away from probably more than $1 million in his deal because he refused to stay after acquisition. He was a military Navy officer, and he said, I will not be happy going in every day if they're not running the business the way, they're not taking care of the baby the way I would have. So part of that is also being able to walk away.
Yeah. So, and we've kind of talked about selling the business, but your book covers both sides, the seller and the buyer.
Correct.
And you kind of discuss the things that a buyer should be looking at. And the way I look at it, Stuart, is I kind of invert it. And if you understand what a buyer should be looking at and what a buyer finds valuable, to you as a business who is a potential seller will understand how you have to structure your business to make it as attractive and as valuable as possible. You agree?
Agreed. That's the, you don't want to say putting lipstick on a pig, but the other side of the coin is that you're going to get way more value if you've taken steps in advance, like if you can deliver an intact management team. Someone's going to buy you. They're not going to want your key managers to walk out after the acquisition. And
we're gonna get into some of the specifics.
But the idea is, how do you build the value of your business?
That's right.
And the building of the value of your business is one, your most valuable resource is generally your employees. So figuring out how you are going to hire, train, and retain your key employees is the non-financial side of things.
And so,
That to me is the non-financial pieces sometimes get overlooked.
And when you're doing an assessment of a potential purchase opportunity, you may be the buyer. You're looking at the same thing.
Exactly. So yeah, I want to know that as the buyer, I want to know that I'm going to be able to retain the key employees. If I can't, then I'm buying it, and maybe I'm going to force competition against myself.
Right. So when you talk
Second,
about retaining key employees, what either side doesn't matter. What would you be looking for to
I
help
would be
assure
looking
you?
for there are a couple of things. They
Mhm,
might have some form of employee ownership with certain key employees own stock, and
mhm,
therefore there's a covenant. There may be a phantom stock plan that gets paid, on a change in control that
mhm,
will help you with non-solicitation, but will not probably help you with non-compete because
mhm,
that's tied to employment, as you know,
mhm,
versus ownership. Another common one is stay bonuses. I have that is the concept of if you've got one or two key employees who will run your business, if you get hit by the proverbial bus,
mhm,
the idea of saying to them, look, I'm not immortal. If I make a planned or unplanned exit for the business and you stay for, let's say, you stay a minimum of 12 months after that event, I will pay you a bonus of, let's say, 50% of your W-2 income. Might be 20%, might be, but the point is, and where this come in handy in a couple cases, I've had clients who got cancer, went
mhm,
into remission.
mhm,
Their business survived that, but they didn't know when the next time would happen that
mhm.
they might have that happen. So locking up those 2 or 3 key employees in case he had another serious cancer bout was critical.
So 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 I'm clear. When the sale is happening though, Stuart, is it the buyer that's locking up the company's the
It's
seller's
generally, let me
employees,
put
or
it
is it
this way,
the other way?
the seller has locked up his key employees to deliver to the buyer. The idea here is that a buyer will pay you potentially a higher multiplier for your if you've got a good lock in. He also may say, I'll absorb part of the benefits, but part of this also is that the buyer wants the seller to have skin in the game. So saying, hey, you've given up 5% of the sales price to your key employees to make them happy and stay makes me feel a lot more comfortable than you making me pay to force them to stay.
Okay.
Because that's the other point is that if I'm representing a buyer, I will generally require the seller to negotiate the non-competes, et cetera, with his existing employees part of the deal. Because if the new guy's coming in, they've got fears about losing their job as it is. If this is all taken care of as part of the transaction, before the transaction, where the selling guy is locked in as key people or has developed some kind of plan to lock them in, he's going to be a better candidate.
Are you losing sleep at night worrying about your legal exposure? Every business faces legal risks. The key is knowing what they are and how to best address them. That's where our legal risk assessment comes in. It's a 4-step proactive plan to uncover hidden threats, close legal gaps, and build a stronger legal foundation for your business. This isn't just about avoiding problems. It's about providing you with clarity, confidence, and control so you can continue to grow a stronger and more secure business. You're one step closer. Let's take that step together so you can sleep better at night. Schedule your legal risk assessment today. Okay. All right. So we So I want to get to, and it's actually in the appendix of your book, but I think it's actually valuable, very, very valuable information, where you talk about the 17 factors,
Yep.
or the 17 factors that determine the value of a business. Right?
Yeah, and I want to break
that's
it up. There are four main
right.
categories.
That's right.
There's finance.
Before we get to that, but you created these factors, and
Yep.
you broke them into four pockets, but it's the factors that both a buyer and a seller
Oh, yeah.
should be looking at and analyzing.
Well, you hit the comment before, Marlon, which is what I
Mhm.
tell my clients is, if you were buying you, would you buy you?
Mhm.
And if not, why not? Okay.
Mhm.
What are you know, assuming that you are a sophisticated businessman, obviously you're always going to try to get a little more money than what you would pay if you were buying, but
Mhm.
the basic concepts are still the same.
But let's get into those factors.
Okay. Well,
And you
yep.
broke them down. The first subgroup is what you identified as financial factors.
Correct. And the
And the first
financial
one is revenue.
factors,
The
yeah. And consistent revenue growth is going to be important to a buyer to see what he can do. And especially if he is a strategic buyer, where he's looking at some form of horizontal or possibly vertical integration. So he's going to want to know how he can penetrate those markets. He's also going to want to look at, are you a mile wide and an inch deep? In DC, we have a lot of GovCons as an example, and they do everything from soup to nuts. No one is going to buy them because they don't necessarily have a concentration. No one's going to want to jettison the other businesses. So the concept is you need to pick some specialties, concentrate on those specialties, which raises brand awareness, hopefully raises productivity, and makes you more efficient. It's like it's being multiple products or being highly dependent on one or two clients is the same thing in my mind to a point of having a governmental preference like A or service disabled, etc. You are significantly limited to the buyers who will take you. Because if you're in one of those preferences, they're probably either a younger company that's buying you, or they're a more established company that can get qualified.
Okay.
And if you're being guided by third parties, they're going to be more concerned. They're going to say, "Oh, can I absorb? How much revenue loss do I have if I jettison these lower profit margin items?"
Now, you also talk about overall size as one of the financial factors, and you said, size matters.
Well, the size matters in the sense of, one, economies of scale.
Okay.
Two is the larger you are, the more likely you will get if all things being equal, you will get a higher multiplier.
Okay.
And there's a certain cachet that if you reach a certain size, you must be doing something right. You don't get to be $150 or $100 million company doing things all wrong. So when you reach a certain size, there's a certain credibility that it's, as long as you're generating a reasonable profit margin on that 50 million. And that, to me, is probably the underlooked area in transition planning. And that is profits versus free cash flow.
Okay. So
Because you have to generate profits to generate cash flow. Cash flow is what's going to grow the business, or also used to fund acquisitions. And so you have to, it's maximizing, it's minimizing tax, it's minimizing your taxes in order to have the additional capital to grow or to buy other businesses.
All right. So where does that, because I'm trying to go down the list of factors here, And
It's
then
really
the third is profits.
profit. Yes. And in profit, you see, I look at profit in one way as a measure of what you can do, but the other side of the coin is profit also has to be measured against cash flow.
Okay.
Okay. You can have some highly profitable companies that don't cash flow very well. And if they're not cash flowing well, that's not going to be good. So the object here is, are you generating sufficient enough working capital from your profits?
Okay.
So that's where you have to look at that is focusing on the idea of it's not just that people over focus on the income statement in some ways at the expense of the balance sheet. Because if you do not have strong working capital, which is current assets versus current liabilities, if you don't have a strong working capital, you're hindering your growth, your ability to grow.
Okay. So in the profit factor, you speak of a term that many people know of and tend to just focus on is EBITDA.
Yes.
Can you just explain to my audience
Okay.
what is EBITDA and then how that
EBITDA
plays?
would be your quote profit before taxes, before depreciation, because it's a non-cash item, before amortization, and before interest, because interest is not, unless you're a passive company, interest is another income item. So when you're evaluating the company, you only want to evaluate its operations. And that's why EBITDA is used to a point, because it's almost a cash number.
Okay.
It gives you your cash profit before you pay debt.
And that is the number that's often used that's multiplied against to determine the value of
Correct.
the company.
Yeah. And those multiples will range based on size of the company, who your buyer is another one, because there are really two types of third-party buyers. There's a financial buyer who's buying it because they think they're going to make money just off it, and they're happy with an 8 or 10% rate of return, which is what you're generating. And it's really important at that point that you retain management.
Mm-hmm.
The other type of buyer is potentially a strategic buyer, someone who's buying you because they want your product, they want your personnel, they want you have something that they think they need. They may be a little less concerned because they're probably larger with certain employees being retained. An example I commonly give is that a lot of companies grow. Today, they need an HR person.
Mm-hmm.
However, if you're going to be acquired by a larger company, they probably have one. So you don't necessarily have to protect them. In fact, with a lot of my GovCon clients that I know they're going to be sold, I have them use someone like Inspirion, because then they can just terminate that whole HR department effectively when they sell with no cost.
So I want to just focus a little bit on the EBITDA and the multiplier. It is often that number, that profit number, the EBITDA, by the multiplier. The multiplier can change. It depends on the industry, and that's depends on some other
Hot
factors.
industries, right before the pandemic, a lot of the IT companies were going at multiples of 12, 14, 16.
Right.
Today, those are rarities.
Right.
The general range is probably 4 to 10.
Right. So basically, what that would mean is that if your EBITDA is $1 million, and
You're worth somewhere between 4 and 10.
you're worth, as far as the good prices, between $4 and $10 million.
Yes, but
Uh-huh.
let me put a caveat on that. A multiplier is not completely accurate if you're dealing with a company with someone that's more capitally intense, because it doesn't factor in the cost of equipment. Like if you're in construction, EBITDA may not be because you have to buy all this big, heavy equipment. And that doesn't factor into the EBITDA calculation.
Mm-hmm. Mm-hmm.
That's where free cash flow or a discounted cash flow method is probably better, because it does look at the debt you've incurred.
But I want my audience to really understand, to get a general sense. It's not
Mhm.
necessarily to the dollar or specific, because other factors why people hire folks like you to kind of really get a good valuation of the company. But it's just
Yep.
a general sense of vice versa, whether you get a sense of your own company or get a sense of a company that you may be interested in buying when you're having like those initial conversations, let's just say.
Well, I would go one step further, and that is that if you're selling the company, the seller should do due diligence on the buyer.
Mm,
You want to know, if you're selling, you want to know that he's going to take care of his employees. If he's done other acquisitions,
mhm,
how's he treated the other people? So you want to know that that you do want to do a little bit of due diligence on the buyer as a seller to know that, you're dealing with a guy who's going to treat you right.
mhm. Factor them and move on to factor 4, which you speak of, is
Projections. Yes.
accurate projections.
Okay. Probably the biggest reason business fail
Mm,
is not sufficient cash, is not having. So that's where the idea of what I was talking about before is focusing on free cash flow rather than necessarily EBITDA. Because you've got a whole bunch of debt to pay back. You may be profitable, but you don't have cash to grow. I've got a client like that right now that I'm working on a valuation on. They're getting crushed because their cash flow can't can't pay all the debts can't pay all the debts out there, pay management, and also start the buyout of one of the founders.
mhm,
There's no there.
mhm, mhm.
And so,
Yeah,
and it's also the whole idea is that uh, it makes if the buyer can look and sees that you are living in projections and he can see how management reacts to those projections. He knows what kind of management team he has. He knows the management team, if they're good at watching budgets. So
mhm,
if you have that kind of financial reporting, one, it makes it a little bit easier for the owner to delegate because he can monitor those things until he leaves. But two is it's also shows the buyer, hey, we do good financial projections and our projections are, you know, 95% accurate for the
right,
last 5 years.
right,
You're going to have a lot less hassle in due diligence when they go to acquire you
sure,
than if you have financial records that you keep on having to restate.
gotcha. So
So
now we
that's going
get
to add
to
time and cost to an acquisition if your
absolutely,
projections are not good.
absolutely. So
And
factor number
also, one
f
other thing about projections, a lot of deals are somewhat self-financed, that they borrow money against the company they've acquired. What do banks look for? They're looking for a steady stream of cash flow. And if you can again show financials that your projections have been on when the buyer is taking your finances to the bank to get financed, they're going to have a lot more confidence, which means you're going to have a larger likelihood of closing a deal.
so let's
And
talk
when I
about
say that, let me add one last thing that I think is really key. And that is 65 of the deals that go to a LOI do not close.
and explain my audience what's LOI.
Letter of it, so basically, when you start the dance, an acquirer will submit to you what's known as an LOI or a letter of intent. It will have the basic business terms of the transaction, who is doing what drafting, whether there's exclusivity, whether there's confidentiality, timetables, etc. And one of the things that in there is usually going to say that the buyer has 30, 60, 90 days to go through all your financial records and so on to decide whether they want to go, whether they want to reprice it or anything else, because an LOI can be repriced. So the concept here is that when they see good records and preliminaries before the LOI, then they can give you a shorter close because they know they're going to get through their due diligence more quickly. They
Mhm.
know their bank is not going to have as much an issue. The other side of the coin is bad financial records and bad financial reporting can kill a deal.
That's right. That's right. That's right. So now let's get to factor 5, which is the balance sheet. What's the
I sort of talked about that before. It's the idea of cash flow that I tell any client that is starting a business, they need to have a minimum of 6 and preferably 12 months of their personal operating expenses in the bank. Because more bad decisions are made if a business owner is more worried about paying his mortgage than how the business is running. So you need that piece of it. But then the other side is you need to know that you can pay your bills. So making a profit but not showing cash to be able to pay your bills is a
So it's
problem.
interesting. It's interesting what you just said, Stuart. If I heard you correctly, you said that the owner should be able to show that they have 6 months or so in their personal.
Where they start. I'm talking about if you're starting out as an entrepreneur, you're not going to get any money out of that business for probably a minimum of 6 months. So how are you going to pay your mortgage?
Okay.
If you don't have the idea that you need, if you're going to start out and you're not going to put a stress on the business, you need to make sure you have enough cash in hand to take care of your personal expenses until the business can start to pay you. Because you will make, if not, you make decisions to bring in cash that may be contrary to your long run growth.
And I want to address that because and maybe at the balance sheet is the best way to do it. Because what a lot of owners do, right? Not a lot of owners don't pay themselves or don't pay themselves adequately with the thought that everything's going back into the business and that increases the value of the company. What is your thoughts on that?
Well, in most, okay, let's deal with a couple of quick things. First, the vast majority of transactions are asset sales. Buyers don't buy cash. Generally, the sellers get to keep the cash. So building up cash doesn't necessarily add value to the business. It's cash you could take out when you sell. Cash, on the other hand, is needed if you're in a growth mode and you have to borrow because you got to pay. You don't get a deduction for paying back debt. You got that deduction when you bought the equipment through depreciation. So the idea here is that you need cash to be able to spend on things that you don't get to write off right away. Now, right now, we have this accelerated depreciation that came in the new tax bill that gives some comfort. But if you're, building an office building for yourself, you're not going to recoup a chunk of that money for 40 years. Where do you get the cash to cover you're not going to be able to depreciation isn't going to cover the mortgage payments. That's why free cash is in my mind, is such an important concept to know how much cash profit you have.
Okay.
That makes sense?
Sure. So let's now move on to what you call a contingent, what y'all label as contingent liabilities. That's
Okay.
factor 6.
I would say factor 6 is really twofold.
Okay.
Is contingent liabilities are a guarantee that the company made that hasn't on a debt would be a contingent liability. If the company guaranteed some loan to the business, and if they're or a loan to a supplier, so they could get the equipment they needed to go, they guarantee that loan. Well, if that loan gets caught, but here's the other one that we see here is that business doesn't start and stop while you're in the transition mode. So suppose you're putting a bid for a major contract while you're in negotiations. That contract may or may not come in before the acquisition. That's a contingent asset. So how do you address that in the acquisition structure? Is it an earnout? Is it a contingent note? There are different ways you can recognize that, but there are, quote, contingent assets in certain industries. So that it runs both ways.
Sure.
The big liability, just the small but big liability that most people don't realize when they sell the business is they're terminating all their employees. The acquirer is going to want them to pay off all the PTO. So if they have a generous PTO plan and you're only halfway through the year, there's a significant check going out to the employees, which takes away cash from the deal.
Mm.
Okay.
Can we get to the customers and the contract factors?
Yep.
And again, this is reiterating it's about how to really determine the value, and these are opportunities to increase the value, these factors,
Yep.
right? The value of your business.
Right.
Your factor 7 was customer focus.
Yep. And the concept here is, how long do you retain clients? What percentage of your work is in any one client?
Mm.
Okay. I tell clients that we should shoot that no one client is more than 5% of your revenue. Ideally, 5% is the cutoff. You can get to 10 as long as you don't have multiples of 10.
Okay.
But the concept here is you want, and within that customer focus, you want to deliver the products to them that they want, but have the highest profit margin. So one of the things that in customer focus is if you've got low margin products that the customers aren't necessarily buying as much, why are you spending resources on them?
Mm.
That's sort of, again, where financial projections coming in to look and see, okay, I'm selling this widget and I have a profit margin of 3 cents. I'm selling this widget and it's got a profit margin of 20 cents. Where do I want to spend my money on marketing?
That's right.
What do I want? And if they're willing to pay 20 cents, what makes that widget worth 20 cents compared to the 3 cents in the customer's mind? Because he's the one who's paying that higher price. So why is he willing to buy your higher margin products?
Right. Factor 8, customer retention record.
If you have if you can say, I've had this customer for 10 years or more, and you have a whole bunch of those, that speaks volumes of how you treat people.
Mm-hmm.
You do not, I tell clients, because there's this turn between collection of receivables and customer retention.
Mm-hmm.
You do not want to be suing your clients very often for non-payment.
Right.
Okay. That just does not bode well. So part of that also is in customer focus. Don't let your clients get ahead of themselves. You'll make more points with the client by saying, hey, you might want to do 10% less right now to we see how this shakes out, than trying to sell him that additional 10% and him getting stuck with it for an extended period of time because he didn't think well. So thinking of your clients when they're ordering product is something that you should consider a little bit.
So that's a good point, Stuart. Factor 9, contract backlog.
Okay. This is, I'll speak, in one of the industries I do a lot of work in is the auto body shop agreement. And I want to know how many cars are sitting in the parking lot that they're waiting to work on.
Yeah.
And if that backlog is too long, then they may need to grow. If the backlog is too short, then they need to do more marketing. That's going to measure you don't want, there's 2 types of backlog. In GovCon, you have you sign a 5-year contract, let's say. So you got a 4-year at the end. If you sell at the end of the first year, you still got a 4-year pipeline there. You got a 4-year backlog right there. But more is also, what's your daily backlog? How quickly, if a client brings stuff in, is it sitting there waiting to get serviced? Or are you turning around quickly and can fill more?
Because the more that's sitting there, that means you're not really being efficient.
Exactly.
with your production.
You're
Right.
not being efficient with your production, or you have some inventory management issues. Now that's been multiplied a little
Which
bit.
means you're losing money.
Yep. And that
Somehow,
brings
some
you
way,
to
money is
supply
being
chain.
leaked out of the company.
Yep. You're losing that money.
That's right.
And again, it goes back to your financial projections again, to a point, because
Sure.
you have to be able to project your needs and how quickly, because here's the other point. You're low on work. You take a whole bunch of work that's going to be out 3 to 4 months from now, and then all of a sudden you can't service it all. So if you don't monitor your backlog and make sure that when you're going to do it, you have everything you need.
Right. Right. So and that kind of flows into the factor number 10, your business pipeline.
Right. The concept here is, what are you doing? You want to create a product that's repeatable with a high profit margin. So what are you doing to market those products and to build out, especially in building out areas where you're building product for clients, how quickly do you turn them? Here's the thing I would say, your new business pipeline, a good example is in a restaurant, how many times they turn a table on Saturday night.
Yeah.
Okay. If they're not turning a table 2 to 3 times, they don't have much of a pipeline. If they're turning the tables 2 to 3 times or more, then that's quite a pipeline. They have people.
They're getting people in the door. They're getting people in the door. And
exactly.
the business
So
pipeline, more customers, more customers.
Yep. So pipeline can be direct, like, I got this long-term contract that I'm going to be fulfilling over the next 5 years. Or it's how many times you turn a table. Are you able to turn a table in a restaurant 3 or 4 times in an evening? Or are you only turning it once? Contract vehicles is more for government, in the government sphere, and because Dick was a government contractor, we focused on, and sub versus prime. But the concept here is IDIQs is basically a hunting license. Means you can put in bids for particular products. What you'd rather be is awarded a prime contract, or being a sub to a very large prime is going to cover you. Yep.
What do you mean by contract?
Okay, a contract vehicle is, there are different types of government contracts you can bid on.
Mm-hmm.
One is what's called an IDIQ, which basically says that you may get no work from this contract, but we may sell as many as 10,000 of your items, but there's no guarantee that we're going to buy those 10,000 items necessarily from you, because there may be multiple people that have IDIQs for that particular industry, for that particular government agency. Then there's being a prime contractor. There is also being a subcontractor to a prime contractor. And there are also teaming agreements.
Right. And the highest value in those contracts are the prime.
Prime direct contracts are always going to be the highest value, because they're going to have they're going to have a contract price. An IDIQ will say, we're going to spend up to this, with no guarantee they spend anything.
Sure. Exactly.
So that's the big difference.
That's the big difference. So now we get to the third bucket of the 17 factors, and this is what you call a service offering.
Yep.
Product and service offering. And you talk about business focus. What is that?
The concept here is, what's your overall business reputation? What do people on the street think of you? Are you known as an expert? Do you have the credentials?
You have a recognized.
Do your customer, do your service people know your customers' names? Do they have a rapport with them? Do you provide real personal service? There are a couple of different ways you can distinguish yourself, but you have to choose. You could be the innovator, that you always have the most innovative product. Or you could say, have the best customer service. But the point is, you need to pick a focus on what you're trying to accomplish, and you need to do research on that. You got to do follow-up and find out, hey, how'd we do on this job?
So
People
your
like
brand and reputation is the key.
exactly. And how do
when you
you,
speak
and
of brand
monitoring
focus. Yeah.
and monitoring the brand.
Let's move on to factor 14 and 15. Like they're separate, but they're very similar.
Yep.
Is specialty offerings and intellectual property.
Okay. One of the things that's very key here is the one thing that's not is not protectable technically are trade secrets. So how do you, if you're getting ready to sell, what do you do to protect your trade secrets? Because those aren't going to necessarily be covered by a patent or a copyright, but there may be procedures. So what are you doing? What do you have that says, as an example, if you leave the company, you have to turn back over all our operating manuals. You know what? With IP also, if it's relating to one or two people, what are you doing to make sure they stay with you? Because the IP is developed by an individual usually. What do you? I just had a deal where it took us 4 months to negotiate a deal with an employee to become an owner because he had used his own software to develop a product for the client. And now he said, you want to use this, you got to buy my software. That it should have been dealt with before they got to that point.
Well, yes.
And it's also expertise. As you said, if you're known as an expert, people will come to you. So that's developing specialty products, expertise. And that's where I say you got to be careful not to devalue your high quality products by having a lot of low value stuff in there. You wouldn't go to Target to buy a diamond ring necessarily. So if you're too general, you may have the higher end products, but people aren't going to think of you when it comes to buying the high end products. So therefore, you're wasting resources spending money on a high end product that probably is going to have a low inventory turnover.
Sure. And so now we get to the final bucket, and you call it management and staffing focus bucket.
Right.
And there's two factors in there, factor 16 and 17. And management team, which is your leadership team,
Right.
and then staff credentials. Talk to me about both of those.
Okay. Well, as I said, the most valuable asset you have usually are your employees. So what are you doing to find new ones if you're growing? What are you doing to make sure that they're motivated? What are you doing to make sure they stay? And do they feel valued? The concept here is that, as we talked about, delegation is important. Well, if my comment that I will make to you that goes along this line is that if you can't take a 3-week vacation without having to call in every day, then your business is not ready for sale. Because if you can't go away and know and know that the business can run successfully and people aren't calling you every day, you're not ready yet. Because and the problem is, Marlon, it's that example is that a lot of owners feel, oh, I could train them, but it's a lot more quickly if I do it myself. But that doesn't add value. The DIY, doing it yourself, does not going to grow the value of the business. And what you end up with is a bunch of yes men, because no one will make a decision without you. And you'll chase away the people who are good managers because they're going to feel frustrated because they're never allowed to make a decision.
And one of the issues, and I think your factor 16 and 17 raise, is the need for written policies and procedures.
Oh yeah,
right. Because when someone is looking to purchase your business, they look as much as they look at the people, they look at what's behind the people. What policies, procedures? Are they able to? Are you able to bring in someone new and get them up to speed quickly because you have those policies and
And
procedures?
that's what we were talking about, trade secrets. Like a couple of my body shops that I've worked with in the past had
Mhm.
developed that said, if you're doing this type of bumper, it should take you this long. This is the steps you take.
Keep KPIs.
They built very strong KPIs,
Mhm.
and that added a lot of value when they were being bought.
Mhm.
Now, in some places, though, if you're being bought by a consolidator, those KPIs are probably worthless because because the consolidator has their own KPIs and they're
Sure.
going to use them. And that's it. So it depends on, again, who you're selling to.
But now these, remember now, but everything's always interrelated. So in that instance, the KPIs themselves may be useless,
Right.
but the KPIs have been beneficial because you created those KPIs. It probably made you more efficient in the
Which gave you a
production,
higher profit margin,
and you now
etc.
have a higher profit margin, which in fact affects your EBITDA, which affects everything. So it all is all interrelated.
Except one thing that comes in, Marlon, that you sort of hit on,
Sure.
and that is if you are a consolidator, they're going to value on gross sales because they don't care what your profit margin is because they'll either
Mhm.
do better or worse. If you're looking at an industry where it's not a consolidator and they're looking to grow, they're going to be more interested in your gross profit and your net profit ratios and your EBITDA than they are your sales. So that's a piece to look at of who you're selling to again and what you want to concentrate on.
So we were able, and thank you, Stuart, to go for going over these 17 very important factors. Now, I have warned you before. I call it warning in our previous conversation
Yep.
that I would do this, and it was basically if all of my guests ask them if it's advice that they can give. I used to say three things, but it doesn't have to be three. What advice
Okay.
would you give to business owners?
First, exit strategy begins the day you start your business, because if you don't know where you're going, how are you ever going to get there?
Mhm.
Goes to planning. Secondly is most business owners spend 99% working in their business and 1% on. If you are trying to transition and grow, you can't do it on 1%.
Mhm.
The last one I would use is that what made you successful as a business owner can be a drawback when it comes to building a transition plan.
Mhm.
Because if you don't, what made you successful is doing everything yourself. It's
Mhm.
very hard for you to say, "Oh, I'm going to change now because I'm selling the business," but you won't have anything to sell if they have to depend on you.
And I actually I would piggyback on that if I can, Stuart, because I think
Sure.
one of the issues that come up and particularly when you're trying to sell your business is that it's personal for you. You built it, you put in all your sweat and all your tears, and it's personal. So you have a certain value that is that you equate to your business that may not necessarily be supported by objective factors. So
Correct.
very important, I think, for anyone who's looking to potentially sell their business to get an objective point of view, someone like yourself, to say, hey,
Right.
this is where you are now based on all these factors. But every one of these factors we've talked about are things that you can improve upon, which will ultimately not only help you run a better business and run a more profitable business, but make your business be more valuable if you choose to sell it.
Correct. Correct.
And thank you very much for enlightening my audience where that's concerned. So, Stuart, you have one thing I wanted to talk to you about that's unrelated to valuing businesses, and you have another talent that you didn't talk about, and that
Yes.
talent has almost led you to. It's not Broadway, but it led you to the bright lights in New York.
Yes. I have been taking voice lessons now for 15 years, and I guess persistence paid off because in
Mhm.
November, I was lucky enough to perform at Carnegie Hall.
Congratulations! Congratulations!
Yep. And the other thing is family is most important,
Hmm.
and that's part of this is that family needs to be involved in the transition planning. Because here's the other point. I've told many a client, I've asked them, what are you going to do when you sell your business? But, they can be various answers. But the one thing I've said to them consistently is, if you think you're going to sit at home afterwards and not end up getting divorced from your wife, you're tempting fate. You need to have a plan for post sale of your business.
Well, Stuart, thank you so much. It's been,
My
again,
pleasure,
very informative.
Marlon. I've really enjoyed this.
Awesome. And take care. Thank you again.
Thank you. Have a great day.
Thank you for listening to this episode of Kicking Ass and Taking Names, a business owner empowerment podcast. Remember, information is only as good as its application. So start making transformational changes to your business and life today. If you like the show, follow wherever you get your podcast. And if you are enjoying this on YouTube, hit that subscribe button and leave a comment letting us know what you think and what you want me to talk about in a future episode. If your business needs a legal partner, contact us at www.glgdc.com. Thanks for listening, and I will see you next time.